Let's talk about China, a nation long celebrated for its economic miracle, a country that for decades seemed unstoppable as it transformed from a rural backwater into the world's second largest economy. But beneath the surface, there's a looming crisis that threatens to unravel much of that progress. For years, China's growth was fueled by an unprecedented borrowing spree, with local governments, companies, and even households taking on massive amounts of debt. This created a mountain of obligations that now overshadows its entire economy. Conservative estimates put China's total debt at 300% of GDP, but some analysts warn it could be as high as 450%. That's a staggering figure even by global standards. Imagine earning $50,000 a year but owing $225,000, or even more. Now multiply that by the size of a nation of 1.4 billion people, and you start to see the scale of the problem. By 2022, Chinese banks held $54 trillion in assets, mostly loans, more than double the U.S. banking system, despite China's economy being significantly smaller. These banks are the backbone of China's financial system, but they're also carrying enormous risk. This isn't just a number on a spreadsheet, it's a ticking time bomb at the heart of the global economy, with the potential to send shockwaves far beyond China's borders. China built entire cities no one lives in, ghost towns with empty towers and deserted streets, the result of overzealous construction and easy credit, and airports for towns of just 50,000 people, all on borrowed money with little hope of ever turning a profit. The illusion of endless growth is fading fast, and now the bills are coming due, projects are stalling, and debts are piling up with no easy way out. This isn't just one sector's problem, it's a systemic addiction to credit, woven into every corner of the economy. Local governments, state-owned giants, private companies, everyone's been drinking from the same trough of easy money, convinced the good times would never end. The result? A fragile, interconnected web where one failure could trigger a catastrophic chain reaction, threatening not just China, but the global financial system. The world watched China's rise with awe and apprehension, marveling at its speed but worrying about its sustainability. Now apprehension is winning as we brace for the moment this great wall of debt starts to crumble and the consequences ripple outward. The story of China's economic miracle is starting to sound more like a financial horror story, with uncertainty and fear replacing optimism. And the world is watching nervously as the cracks begin to show, wondering just how much longer the facade can hold. So where's all this debt? China's made an art of hiding it. Instead of one big obvious pile, it's scattered across thousands of entities, impossible to track. Local governments use shell companies called LGFVs to borrow off the books, ballooning hidden debt to at least $12.6 trillion. Add that to official borrowing and you're looking at 160% of GDP, higher than the U.S. Then there are state-owned enterprises, hundreds of thousands of them, collectively holding around $30 trillion in debt. Everyone assumes the government will bail them out, encouraging reckless borrowing. The real danger isn't just the amount, but the opacity. No one knows where the risk really lies. This system is fragile. A default in one corner could trigger a cascade of failures. The elephant is hidden, but it's still in the room, and it's looking very sick. China's debt isn't just big, it's dangerously well camouflaged. People often compare China's debt to America's, but it's not the same game. The U.S. borrows in dollars, the world's reserve currency. Everyone wants U.S. debt. The Fed can print more dollars if needed. China doesn't have that luxury. The yuan isn't a global reserve, and few want to hold it. Most of China's debt is internal, tangled between state entities and hidden from view. In the U.S., debt is transparent. In China, it's a shadowy mess. If a crisis hits, no one knows who's solvent. Panic could freeze the system. America's debt is a long-term challenge, but manageable. China's is a systemic risk, opaque, poorly structured, and lacking a global safety net. The U.S. has a mortgage, China's living in a house of cards, and if it collapses, it could take the global economy down with it. The difference isn't just scale, it's stability, and right now China's foundation is looking shaky. Here's the baffling part. China printed money at a breakneck pace, with its money supply growing 16 times over just 2 decades. That's an expansion so rapid it would make most economies tremble. Yet despite this tidal wave of cash, inflation stayed flat. Normally, when a country prints that much money, prices skyrocket and everyday goods become unaffordable. But in China, it didn't happen. Why? Because the new money didn't flow into people's pockets or daily spending. It was funneled into building factories, highways, and endless rows of empty apartment towers. The result? A glut of supply, but not enough demand to match it. China's economy is like a baker making thousands of cakes but selling only a handful day after day. Instead of inflation, China faces deflation. Too much stuff, not enough buyers. Shelves stay full and prices even fall. Companies can't raise prices, profits shrink, and investment dries up. Factories slow down and workers worry about their jobs. This isn't a sign of strength, it's a warning flashing across the economy. The money printing inflated asset bubbles, housing, stocks, and more, but not real economic activity that benefits ordinary people. China's economy is unbalanced, strong in production but weak in consumption. Factories hum but stores are quiet. The lack of inflation signals a sputtering engine, not a healthy one. Growth is slowing, and warning signs are everywhere. The money never reached ordinary people. It just built empty cities and left homes unfilled. Now those bubbles are starting to burst, threatening to drag the economy down even further. The danger isn't runaway prices, it's a slow, grinding collapse that's hard to stop once it starts. And the consequences could be global, rippling out to affect economies and markets everywhere. To understand China's deflation, look at its people. They save but rarely spend. Household consumption is just 39% of GDP compared to 68% in the US. Why? Weak social safety nets force people to save for retirement, healthcare, and emergencies. With few safe investments, families poured savings into real estate, inflating a massive housing bubble. The government built an export and investment economy but never fostered a true consumer society. Now, as global demand wanes, China's lack of domestic spending is exposed. The country is stuck. It needs people to spend but hasn't given them the security to do so. All those savings fueled an asset bubble, not a vibrant economy. The imbalance is now a threat to the entire system, and the fallout is just beginning. If debt is the time bomb, real estate is the detonator. For years, property was the engine of China's economy and the main store of wealth. But it was a fantasy. Prices soared to 35 times average income in cities like Beijing. People poured savings into homes, often unfinished, as developers like Evergrande defaulted. The market became a speculative casino, not a place for shelter. Now the bubble is bursting, wiping out savings, bankrupting developers, and starving local governments of revenue. The entire ecosystem is collapsing. This crisis is the result of a flawed model easy credit, rampant speculation, and government encouragement. The stock market floundered, so real estate became the only game in town. But growth built on sand can't last. As the tide goes out, the whole economy is exposed, the house of cards is falling, and the shockwaves will be felt everywhere. China's global strategy? Exploit every trade loophole. E-commerce giants like TMU and Shein used the U.S. de minimis rule to flood America with cheap goods, dodging tariffs. By 2023, they accounted for 30% of all such packages entering the U.S. But loopholes close. By 2025, the U.S. eliminated the exemption for China, and Temu's U.S. users dropped 58% overnight. The business model vanished instantly. The world is waking up to China's tactics and patience is running out. Forced to adapt, these companies lost their cost advantage. The era of easy exploitation is ending. The magic trick is over. With the U.S. door closed, China tried a backdoor: Mexico. Chinese factories sprang up in Mexico, using the USMCA to ship goods tariff-free to the U.S. The U.S. trade deficit with Mexico doubled, but it was really Chinese goods in disguise. The U.S. caught on, and in 2025 slapped a 25% tariff on key Mexican imports. The Mexican detour was shut down almost overnight. China's tricks have a short shelf life. The world is closing loopholes faster than ever. The old playbook doesn't work anymore. China is running out of back doors. The global system is adapting, and China's options are shrinking. China's economic model is unraveling. Low interest rates, endless money printing, and global tolerance for its trade tactics are all fading. The pillars that once supported its meteoric growth are now showing deep cracks, and the world is starting to notice. For years, China's leaders relied on aggressive stimulus and financial engineering to keep the engine running, but those tools are losing their power. The tricks are failing, the loopholes are closing, and the debt is coming into the light. Hidden risks are surfacing, and the numbers no longer add up. The financial smoke and mirrors that once dazzled the world are now being exposed for what they are. The question isn't if the system will crash, but when and how bad it will be. The countdown has begun, and uncertainty is spreading through boardrooms and trading floors across the globe. Unlike the U.S., China can't print its way out or rely on the world to bail it out. Its options are limited, and the safety nets are thin. Its system is a closed loop, and the pressure is building. Every failed policy and every missed target adds to the strain, making a blowout more likely. Failed trade gambits are warning signs. China can't export its way out anymore. The world's appetite for cheap goods is shrinking, and global demand is shifting. If the system collapses, the consequences will be global. Recession, supply chain chaos, and inflation everywhere. No country will be immune from the shockwaves. China is the world's factory. A shutdown means shortages of everything from iPhones to medicine. Everyday life as we know it could be disrupted in ways we haven't seen in decades. The contagion would spread. China is also the world's largest lender to developing nations. Its financial troubles would ripple through fragile economies, threatening hard-won progress. A collapse would trigger a wave of defaults across Africa, Asia, and Latin America. Millions could lose jobs, and governments could face social unrest. The global financial system could be pushed to the brink. Markets everywhere would be forced to reckon with a new reality. For decades, the world benefited from China's rise. Its growth lifted millions out of poverty and fueled prosperity far beyond its borders. Now we all face the risk of sharing in its fall. The stakes have never been higher, and the world is watching to see what happens when the music finally stops.